Alright, now sources of the funds: long-term sources, share capital or equity shares, preference capital or preference shares, debenture bonds, term loans from financial institutes, government and commercial banks, venture capital, venture funding, asset securitization, international financing by the way of issue, foreign currency loans, ADR, GDR, etc. Medium-term sources: preference capital, preference shares, debentures, bonds, lease finance, hire purchase finance, medium-term loans from financial institutions, governments and commercial banks. Short-term sources: trade credit, factoring services, bill discounting, advances received from customers, short-term loans like working capital loans from the commercial banks, fixed deposits less than 1 year, receivables and payables. Right now, non-banking funds. Non-banking sources refer to the raising of the finance from the sources other than banks. This may include raising the money through the capital market, money market, institutional investors, private equity or other. Considering the tightening of the loopholes in the lending norms by the banking industry, it is becoming difficult for the corporates to rely solely on the bank loans. Thus, the non-banking sources of finance are equally important. The continuous stress over the banking assets has led to the birth of various non-bank debt sources. Borrowers can also arrange for the funds from private investors, both domestic and foreign, in the form of the both equity and debt. Non-banking sources are considered to be more risky than as they place a greater emphasis on the forced closure of the businesses or taking up the ownership of the businesses to recover the funds. Now, the money can be raised through the various instruments and products like issue of the equity and preference shares, debentures, bonds, commercial papers, and the corporate deposits. Now, bank funding. As the name suggests, funding refers to all the sources of funds that a treasurer can access from the banking institutions. But this may be by the way of the loans, working capital, funding, and fund-based and the non-fund-based instruments. Banks are essentially those financial intermediaries who accept deposits for the purpose of lending. The second most important function of the commercial banks is to lend money to the individuals and the institutions who need short-term and the long-term funds. This part of the study elaborates the various methods of fundraising, the legislative work, as framework as laid down by the appropriate regulator tabular chart of the coverage of the same. Okay, corporate funding, debt funding, equity funding, foreign funding, other commercial tools, and CRPS. Okay. Now, debt funding: Indian non-fund based LC, bank guarantee, stand by LC. Now, equity funding: Indian fund base is also debentures, securitized debt, instruments, bonds, bank finance, working capital, bill discounting, factoring, etc. Now, equity funding: public funding, private funding, non-fund based. Now, foreign funding is ECB, ADR, GDR, FCCB, FCEB. Other commercial tools: intercorporate loans, commercial papers, deposits, and CRPS. Okay, that is another one. Okay, now listing. That is a part 2 listing. Going public and offering stock in the initial public offer represents a milestone for the most privately owned companies. A larger number of the reasons exist for the company to decide to go public, such as obtaining financing outside the banking system or reducing debt. Listing provides an exclusive privilege to securities in the stock exchanges. Now, only the listed shares are quoted in the stock exchanges. Stock exchanges facilitates transparency in the transactions of the listed securities in the perfect equality and competitive conditions. Listing is beneficial to the company, to the investors, to the public at the large. Now, for trading in the stock market, the company has to list its securities on the stock exchange. It means the name of the company is registered in the stock exchange. The company intending to have its securities listed on the stock exchange has to comply with the listing requirements prescribed by the stock exchange. This part of the study outlines the listing requirements to be complied with the company listing its securities in the Indian Stock Exchange, International Stock Exchange. Further, in the part of the procedure for preparing a company for IPO, its governance requirements, post IPO, various documentations and compliance requirements, etc. that has been explained. Now, legal and regulatory framework. Part 1, that is corporate funding. Companies Act 2013, SEBI Act 1992, SCRA Act 1956, Depositories Act 1996, FEMA Act 1999, FDI Policy and RBI Act 1934. Rules, regulations, circulars, master guidelines. SERR 1957, regulations, master circulars, directions, regulations. Now, part 2 is the listing. Indian listing: SEBI LODR regulations 2015, stock exchange listing criteria, and listing in the international regulations of the respective country stock exchange listing criteria. Now, syllabus objective is to provide practical knowledge of means of the finance available to the corporates at various stages of the journey, the sustainability, pros and cons, process, compliances. To acquire knowledge. Part 2, that is listing: to acquire knowledge of the legal and procedural aspects of various types of listing, eligibility criteria, documentation, compliances, etc. Now, detailed contents: corporate funding 60 marks, Indian equity, public funding, Securities and Exchange Board of India, issue of the capital and disclosure requirements regulation 2009, Indian public offer, initial public offer, further public offer, preferential allotment, private placement, qualified institutional placements, institutional private placements, right issue, fast track issue, real estate investment trust, infrastructure investment trust. Now, second is Indian equity, private funding, venture capital, alternative investment funds, angel funds, seed funding, private equity. Now, Indian equity, non-fund based, bonus issue, sweet equity, ESOP. Now, debt funding, Indian fund based debentures, bonds, masala bonds, bank finance, project finance, including machinery or equipment loan against property, machinery equipment loan against property, loan against shares, working capital finance, overdrafts, cash, credit, bill discounting, factoring, Islamic banking, etc. Now, debt funding, Indian non-fund based, letter of the credit, bank guarantee, stand by letter of credit, Okay, debt funding, Indian non-fund based. Now, foreign funding instruments and institutions, external commercial borrowings, American deposit receipts, global deposit receipts, foreign currency convertible bonds, foreign currency exchangeable bonds, international finance corporation, Asian development bank, ADB, and international monetary fund, that is IMF. Okay, there are other borrowing tools also, intercorporate loans, commercial papers, deposits under the Companies Act, customer advances, deposits, non-convertible instruments, non-convertible redeemable reference shares, NCRBs, securitization. Now, listing contains 40 marks. Listing, Indian Stock Exchange is Securities Exchange Board of India, listing obligations and disclosure requirements regulation 2015. Equity listing, SME, that is small exchange. ITP, main debt listing, post listing disclosures. International listing, applicability of the listing regulations, Singapore Stock Exchange, Luxembourg Stock Exchange, NASDAQ, NGSM, NCM, NGM, London Stock Exchange, main aim, US Securities and Exchange Commission, that is a SEC. Okay, various procedure requirements for listing, issue of the listing, securities and listing, prepare a company for the IPO and the governance requirements, thereafter appraising the board and other functions in the organizations regarding the IPO, post IPO listing, government changes, documentations and compliances, etc. Okay, thank you.